Good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday. It's the 12th of November, 2021. And today we want to look into a topic which is combining two worlds, in fact, combining the world of discretionary trading. So the world where you if you pull the trigger yourself by clicking your mouse, and the other world, the automated trading world, where your trading signals are generated automatically, for example, via an expert advisor. And in this context, I want to give you some thoughts, some ideas, some hints how I handle this. In fact, I really, in fact, love to do that. Combine these two worlds. Try to minimize the emotional impact, let's say, by clicking the button, so generating my trades automatically with an expert advisor, and then how to use my expertise in the markets, respectively my experience here to then optimize or smoothen the equity curve. Let's probably put it that way. But we want to start first of all here by give you some thoughts on probably the Bionic Trader. Probably that's a fair way to put it. So use your human being here to your way to be a human being, and everything which goes hand in hand with this. Also your emotions, your way of realizing or identifying patterns. And then use these patterns and formulate a trading setup around this, which you can then automate and then use your expertise here to optimize the outcome of the trade, respectively, to increase the overall expectancy of your trading. So in this context, if you watch this now on YouTube, the recording, which will be uploaded here a little later in the YouTube channel from Admirals, don't forget to subscribe to the YouTube channel. Don't forget to leave a thumb up here if you like what you're seeing. If you have any comments, if you have any questions, if you have any topics for the future like us to be covered, then please feel free to post them right below the video. And did I miss something? No, I think that's it. Subscribe, leave a thumb up here, leave a comment in the chat box below, share the video if you like it, try to increase our reach here so that we can all profit from each other. What I want to do now is I want to share here the first slide of today's presentation. By the way, let me just check the chat box. That's the way here for those right now live in the event to post the questions, and everyone has already found the chat box, but let me just type in hello traders here. So this is where you can ask all your questions now via the chat box within the live event. And now let's move on with today's topic. So combine the best of two worlds, discretionary and automated trading. Before we start, I just want to give you here some details about Admirals, the current rebranding, which has taken place already months ago. So Admiral Markets is now Admirals. It's a Forex and CFD broker with over 8,000 financial instruments being offered. Multi-asset brokerage, we call this, has a global presence with support on local languages here, licensed by every authority which is has a bigger name within the FX and CFD industry. Might be the CISEC, might be the FCA, the ASIC in Australia, for example. Also, as of late, there was another regulatory body added. It's the regulatory authority of Jordan here in this context. Over here in Germany, so I'm located in Berlin in Germany, we usually refer to Admirals as the DAX expert. So probably the most competitive, if not the most competitive offering when it comes to the DAX or DAX trading in general. Very quick, fast order execution, very reliable platform stability in this context. So we mainly use the MT4, MT5, and then certain add-ons, certainly the Supreme add-on. I mentioned this because we will mention this a little later on, but also the Stereo Trader, for example, if someone is interested. But in addition to that, it's also important that you have a broker you can rely on, you can directly talk to in your respective language, respectively, a broker here who's not just saying we offer a spread of 0.8 in case of the DAX, for example, but in addition to that gives you quick order execution. And in this context also, most of the time, 0 to small slippage, but also not just in the negative, but also in a positive way. So to make long thing short, when it comes to DAX trading, CFD DAX trading, usually Admirals comes to our mind here in Germany quite quickly. The same is also true for FX trading. In addition to that, then we have also stocks trading, stock CFDs, for example. As of now, right now, you have 3 round turns for free every day. So that means that you can do 3 stock trades, buy and sell, or in and out, let's put it that way, here. And you don't have to pay commission on top for the first 3 trades, first 3 round turns. That's probably interesting, especially for those watching the stock market opening in the US, for example. And as of now, it's 25 minutes, and we have Tesla, which is probably of interest. If we drop yesterday's lows around 1,055, if I'm not mistaken, there could be a chance for a strong opening drive trade on the downside, for example. Well, 1 or 2 trades, and you don't have to pay commission on that, probably of interest. So long thing short, further information can be found on the website from admiralmarkets.com, respectively admirals.com. One world, one broker. These are here the regulatory bodies in this context where you can find Admirals. So further information can be found on the website. And now we want to dig deeper into today's topic and today's agenda. So first of all, first bullet point here will be the Bionic Trader. I'll give an introduction to that, what I mean by saying Bionic Trader. And then I'll give you an idea on how to combine human pattern recognition here with the use of technology in this context. A strategy which is quite simple. Some of you probably have heard about it. I have probably seen, I'm sorry, probably see me talking about this on Twitter every day, for example, the so-called open range breakout. In the DAX. In this context, I'll give you the setup itself, and then how to not just realize that there is a pattern which occurs over and over again, but also how to then test whether that works or not, or worked. Let's put it that way, in the past. So what we then do, this is the next step, we backtest this recognized pattern, and then this is not where we stop, but we optimize then from there. Certainly, we use our knowledge around mathematical concepts, risk money management, trading psychology. Does it suit our personality here? From a risk perspective, we can run simulations based on the backtested data and everything. But in addition to that, after that, it comes to let's test the setup or the pattern you recognized here in the real world. And here in this context, then we will show you. I'll give you also some details on how to look at it from this perspective, not just the backtested result, but also the forward tested, the real traded world here in this context. And the next and final step, then, I'll give you my way of how to use these 2 worlds. So I'm let's call me pattern recognition machine. So I recognize the pattern, I formulate an idea how to trade the market, and then I automate it and let the trade signals being generated automatically. And then I let the trade play out and use my expertise here. Then if I spot a certain behavior, for example, volume spike or whatever, extension on the upside, on the downside, I then use here my knowledge as a trader to intervene discretionary from this perspective and to somehow smoothen the already rise in equity curve. So I already realized that this is a profitable setup. I just recognized. I tested this back and forward, and then in addition to that, I try to optimize the positive expectancy of this trading setup even further and try to smoothen the equity curve then in this context. And I will show you how I can do this to also minimize here the potential emotions and cognitive dissonances to avoid them, or at least not just it's not only avoiding them, but probably reducing them. So I'm not really sure whether it helps to avoid them, but it definitely helps to reduce them. And finally, I'll give you also an idea here how to use this technology in your trading. So in fact, Admirals is offering plenty of resources for free you can use to really use technology to improve your overall also discretionary trading. So let's start. First of all, let's start with the Bionic Trader. First of all, probably an introduction. What is discretionary trading? What is automated trading? So discretionary trading, I refer to as a trader who enters his trades manually. So it's mostly based, most of the time, it's based on technical analysis, but also sometimes based on fundamentals and sentiment-based patterns. And then you enter the trade. Put it differently. So take this week, for example. So we're now today it's the 12th of November. If we finish this webinar, if you watch the recording, also true, just check out the most recent price action we've seen in gold, for example. So we looked where we attacked, we stabilized slightly below a potential breakout region. Okay, so and the region was around 1,835 USD. And last Wednesday, so 2 days before, so today is Friday, on Wednesday, last Wednesday, we had US CPI data, consumer price index, respectively inflation data. And you've probably seen the recent developments. So you probably followed the financial media, you probably followed some tweets, probably some newspapers you've seen. Inflation is all over the place. Everyone is talking inflation. And so the numbers are something, as of now, it's a mode, let's say. So it's like everyone is watching these numbers. Today, for example, let's put it differently. If you check out the economic calendar from Admiral Markets on their website, the Forex calendar, you will see that there's a high significant event today taking place at 3 p.m. London. It's the consumer confidence from the University of Michigan. To be honest, I don't think that this is a highly important relevant data set which will be released there. But what's of more importance is the data set which will come in at the same time. It's the JOLT numbers. It's the job report number, because it has somehow an impact, potential impact on the inflation itself. We don't want to dig too deep into this concept here, but come back to the gold trade. So we know inflation right now is hot, and every print around inflation, labor data, or labor market data in this case, non-farm payrolls, and here real wage growth and all that stuff. Everything which is related to inflation is right now a hot topic. So we know this. We also know that gold has somehow a direct correlation here to yields, respectively inflation data, real yields. And so we can expect, or we think, okay, well, there might be a breakout happening. We see that on a daily chart, for example, in gold, we have a high significant region, 1,835. And then, well, we see, okay, there's a fundamental trigger. That's technically relevant level. And we will most likely see a quite heavy breakout on the upside. We don't know how far it will go and how far gold will move from here. Most likely probably somewhere around 1,900, 1,920 probably in the next days. But we somehow expect technical analysis and fundamental trigger coming together here. And what we then do is we enter a trade based on our discretionary idea behind this. So we spot technically relevant level, we spot fundamental trigger, and then we combine these two and we enter the trade manually. So we say, okay, buy stop 832, if I'm not mistaken. That's my entry point, 1,832. I had a stop, was a tight consolidation, 1,819, if I'm not mistaken, so 13 USD per ounce unleveraged risk in this context, and then took it from there. You can see it in the chart. Worked out pretty nicely so far. I'm still in the trade. As of now, I trailed the stop below the lows. We then formulated the relative low, or it's not really a relative low. It's more like a swing low. In fact, on an hourly chart, you can see that at 840, 841 around. You trail the stop there and then take it from there. Fundamentally, technically driven, and also based on my discretionary approach, respectively my trading experience in this context. So this is what discretionary trading looks like. Probably I said a little too much here in this context, but just that you get a better idea. In case of automated trading, it's, well, you certainly also follow rules, but the trades you enter are most of the time automatically entered. And what I just presented here in terms of this, let's call it global macro trade, for example, in gold, based on the current mode around US inflation, it's not really possible, or it's very, very difficult to, in fact, automate this process. But I have clear rules to follow. So buy stop with a breakout higher, then I place my stop level and so on and so forth. And this is something I could automate here in this case. And so what first of all makes the most sense here is that I try to take out human emotions here, the human component, we can call this, completely. So what I'm here try to achieve is, in fact, to minimize the emotional impact, or potential cognitive dissonances in this context. And so the third bullet point here in this context perfectly illustrates that they are very similar, in fact, the approaches, even though one is manually and human-based and the other is fully automated, even though the rules you follow here are entered from a human being. So you have to program an expert advisor here, so you have to code it and then take it from there. So both approaches that might seem clear at first glance here should follow clear predefined rules and have a positive expectancy. So positive expectancy means that you have a positive expected value, which is the definition of being profitable in your trading. And even though one might argue that automated trading is truly, let's say, statistic-based, manual trading has an emotional component attached. And what is our target then in our trading, or at least what I think is a good idea? Well, it's to try to achieve, to become a so-called bionic trader and combine the best of both approaches here. So become somehow a pattern recognition machine, someone who realizes, okay, there is a pattern, automate this process, and then try to not just capture here the potential positive expectancy here, but also try to probably even increase this. And this is exactly what today's presentation is about. And in this context, we want to now have a look here at a pattern. I recognize it's not just, in fact, me who recognized this, but it was already found in other markets, I think in the early 1980s, if I'm not mistaken, late 1970s, from a guy, his name is Toby Crable. And he also published a book. In fact, there was a series. Initially, it was a series within a magazine, if I'm not mistaken. And then he took out the articles he published there and packed them within the book then and published the book. It's a classic. I'm not really sure of the name. Short-term day trading patterns, if I'm not mistaken. Let me just check this out here on Amazon. Let me just see. It's a classic. It's not available, but there's probably, let's call Toby Crable. He's, by the way, also a very successful hedge fund manager. Okay. Oh well. It's probably not so bad. Let's use this here. So that's the magazine, in fact. Let me just go over here. So this is what we will look at a little later on, but here, let me just move over to Amazon. So this is in fact, let's call it Toby Crable. For further details on here on the open range setup itself, and then the markets and his studies here. So it's the opening range breakout package, the English edition, stock and commodities, and here, as you can see, it's 39 pages. Oh yeah, well, it seems as if these are the articles he published there. So probably the book itself contains more input, but these are the articles he published here within this book, or Kindle in this case. So however, let's come back. So it's not that I found this, but it's a pattern which was recognized and optimized based on my personal trading. And so what you can see here is that I say, okay, I realize there's a pattern. So between 8 and 9 a.m. German time in this case, there's a range which the market finds. So playing a high and the low then in this context. I use not 9 a.m., but it's 9:05. The reason for that is simple, because at 9 a.m. German time, the Xetra opens, for example. So Xetra is when the spot market comes in. And the spot market usually means that there's a massive increase in volume around this time. And the DAX, you can see that, sees massive moves on the up and down side. So there's a very erratic environment in this context. And I try to avoid here to be sucked into the action without seeing a clear signal of significance in this context. So this is what I mean with pattern recognition in this case. So I realized, okay, there's a pattern, and the market tends to not just break out then, but move in direction of the breakout. Still, I want to, let's call it, filter out the noise based on my recognition of a pattern, a certain pattern, which happens during that time. So, and then what we have here is we have the entry point with the break lower in this context. And by the way, I also use then here the EMA 50, for example. So there's another point which comes here to mind and directly to mind. It's that you have to find an advantage. So within the market itself. So are we in a long trend? Are we in a downtrend? And here we want to then position ourselves in direction of the overall advantage. Very difficult to tell that. I mean, if you, for example, look right now at gold, you will see, okay, there's a potential bottoming out after the move lower from the recent push to new all-time highs in July, August 2020. The same is also true for silver. So very positively correlated asset in this context. But the thing is how to tell your platform or your algorithm here in this case, or the expert advisor, how to tell it, okay, well, there is the advantage on the long side or is the advantage on the downside. In this context, I really love to work with, for example, exponential moving averages and just say, okay, if we trade above, then the overall advantage is long. If we trade below, the overall advantage is short. So to filter out or to have a filter here, which tells me whether we are in an up or a downtrend. Okay, so then you can see here, you have to really closely zoom in to see that, but we closed slightly below. It's not the perfect example, in fact, but we closed slightly below the EMA 50, which means we have a sell stop then. So we trade breakouts on the downside, which happens here. And what I then say is, I say that I want to here work with a predefined risk reward ratio of 2 to 1. So which means if my risk is defined by the width of the range, so the lower and the higher part here, let's say it's 30 points, then I want to have my take profit being 60 points away, 2 times 30 in this case. And this is where my exit is hit then in this case. So this is the pattern I recognize. So now the thing is, I mean, it's a pattern, it's one chart, and it's one simple example, just for illustration purposes, but it worked only once. Does it mean it works for an extended period of time? Did it work in the past? And this is then where I recognize the pattern and then I test the pattern. I program it because it's very easy to, in fact, program this in the expert advisor with an MQL code here in this case, because you say, well, I have a pattern I look at. So the time span I look at is 8 a.m. till 9:05 a.m. German time. And I say, okay, where's the high and where's the low? Then I say, okay, I have the high and low here in this context. Next step is I want to enter on the long side if the last 5-minute candle closed above the EMA 50 here in this case. Okay, great. I have a buy stop. Stop then at the low of this range. Or if we close below, so it's the close below the EMA 50, well, I have a sell stop here at the high of the range. And then I say, okay, this is the risk, obviously. Based on that, then I say, okay, then the take profit will be 2 times away the initial risk I took. You can also include some risk money management parameters. Just say, okay, I want to risk, let's say 1% per trade, or put this in euro, USD, GBP, JPY terms, whatever account or as a currency you have in your account, and just say, okay, I want to risk, let's say 100 euros per this trade. And so then the position size is calculated automatically. But however you put it, you can see you can follow clear rules. You recognize a pattern, and then you have to write down, if this, then this, if this, then this, if this, then this. You write it down, you code it. And then you have an expert advisor in this case, so an MQL programmed. And then, as you may have seen already, if you may have found out yourself, is you can test the strategy. You can test the recognized pattern within this time span. And if we do this, you can see it here. I did this. I screenshotted this, in fact, from my book. It's a German book. I also wrote a book here in German. I'm an author of a trading book. It's called Trader. And so I looked at here at this time span. It's a very small time span. In fact, I prefer to have a larger backtest sample size in this context, but I was missing some history here, so that's the reason why it's only 1 year, or slightly more than 1 year, in fact. But I already see that the pattern itself seems to work. So you can see that here. So this is the equity curve you receive if you enter these parameters into the expert advisor. It was a quite profitable approach here. So it's in German. Don't be surprised now. It's a German screenshot, but it's just for illustration purposes that you get an idea. Okay, that obviously works. So the equity curve is rising from the lower left to the upper right. Very good, because it shows the market or the capital is rising. I started with a 10,000 euro account here in this example, and the generated profit was based on these input parameters within this time span around 17%. And so you have also plenty of other information here. For example, the biggest winning trade, it's 227 euros, for example. You have average losing trade here, for example, of 99.70. I'm sorry, that was the biggest one. I'm sorry, the biggest one. Here is the average winning trade. It's 157 in this context. So average losing trade 99.7. That means 10,000 euro account. I work with the 1% risk per trade, for example. So long thing short, hit rate is around 42%. If I'm, yeah, there we go, 42%. So obviously it's a profitable approach. That's nice. That's good. But now the question arises, okay, can we here in this context also now see this development in the real world? And this is where the forward testing comes into play. So in fact, I recognize the pattern, but at the end, you only will see whether you function with this approach. And obviously, it's profitable, it works. So you recognize the pattern, great, but still, you now have to bet. It's you have to take risk now. So to try it out in the real world, else you just won't see whether it works in the real world, but in addition to that, also whether you correspond with this approach. So this is the next thing. I mean, you can have the most profitable trading strategy in the world. The only problem is if you do not correspond with this approach. So for example, we know it works. You will see this also in the forward test. It works. But just imagine now that you are just not a breakout trader, or you're not a grinder, let's say. It's just not fitting your personality. It will be very difficult to trade this approach, even though you see it works. So it's always a question of personality in addition to that, which you find out only by just doing it and go out in the real world and test it. The same is also true when it comes to, for example, let's go to the gym. Okay, let's go to the gym. And you say, well, I want to work out, but the thing is, there's some workout techniques, let's call them, who just work and fit your personality. You function with them, or your overall physical personality. So your physics just allow you to work out a certain way. And then there's other techniques or other workout equipment you just don't feel comfortable with. So you have to find ways how to work out properly, but also in addition to that, that it fits your personality and that you stay in the game, so that you stay with this overall approach. The same is true when it comes, for example, to nutrition, for example. The same is true. So it's like in the real world. The same is true when it comes to how do I feel comfortable? How can I find my zone from a psychological standpoint? So there's ways, different ways. Some people might say, well, I have to just, I have to hang out with some friends, talk with them. I just feel comfortable with that. Then there's other people who say, well, I just hate to talk to others. I can't find my zone here. I want to be with myself, read a book, have a glass of wine, whatever. So it's very, very difficult here to find certain ways, but it's difficult, but you have to test it out. And that's why I say you have to go out and just try it in the real world. And this is what we do in the next step. Then we have the pattern. We realize, oh, 1 second, is there something missing? Yes, there's something missing. So what we now do is we trade this in the real world. And in here, by the way, the time span is larger than that. And it confirms what we found out during the backtest here. So in this context now, what we say, we have a time span here from September 24th of September 2019 till the 1st of October 2021. And here, within this time span, we have now 467 trades being generated. So you might probably wonder, want to say, hey, why aren't there, if there's 360 days in a year, why, or 365, why is that less? Well, certainly there's also weekends in between, and there's also bank holidays, for example. So that's the reason why it's 467. And so you have a hit rate, 40%. This is the same as in the backtest result, 40%, 42%. So it equals out around this range. It's the basic version. So there's no discretionary intervention or something like that. It's just the plain rules you follow by. You have a loss rate certainly of 60% then. And here the payoff ratio is slightly lower than the one we had in the backtest. So 1.5 to 1. You can see that here. So it's the average. Oh, no, in fact, slightly lower, yes. So what you can see here, the average winning trade, 157 divided by 100 in this context. So it's 1.57 to 1. And 1.5 to 1, slightly below that, but still within this range. And so we have consecutive wins of 5 in this context, consecutive losses of 12. Now you might wonder, okay, where do I get this information from? I mean, this is very detailed. How is it possible to get this information? Well, it's very easy, in fact, because there is some technology which you can use for free also within and already within the Admiral Markets environment, in the MT4, MT5 environment with the Supreme add-on. And that was what I opened already here. Let me just go over here once again. So if you click here on start trading products, there on 1 second, platforms. It's platforms. If you go on platforms and there on the MetaTrader Supreme Edition, this page opens, you scroll down a little. Let me just also here share this link. I call this SE, okay, for Supreme Edition. Let me just see. There's 2 questions. Did you program it yourself, and can you show the script, for example? I haven't prepared it, and I also haven't programmed it myself. I had a very good friend of mine who did this for me, in fact, because I'm not a coder myself. I try to get more used to coding, in fact, especially when it comes to Python. We had also some webinars in the past where I presented some thoughts around this, but in this case here around MQL5, it's more in the C direction, let's call it, and I'm not an expert on that, so I didn't code it myself. We'll also do a webinar. Let me just check this out 1 sec. I'm not really sure when we will have the webinar, but if I'm not mistaken, we have it this month or the next. It will be, let me just see, it's November. Yeah, it will be next week. Let me just think. I think it will be next week on Wednesday, if I'm not mistaken. Let me just check it out. One sec. So these are, yes, there we go, 17th of November. So I'm right. So how experienced traders trade the DAX 40. It's the DAX 40, not the DAX 30 anymore. But here's the link for next week's webinar on Wednesday. And here, what I will do, let me just see. Here, I will present the parameters around this setup. Yes, 100%. Do you recommend learning Python? 100%. Yes. I hope that answers the question. Yes, exactly. There's also another, Darshan just says that the average winning, the payoff ratio, so average winning trade and divided by the average losing trade is very stable here in this case. Yes, it has to do with the fact that we're working with predefined take profit levels in this context. So this is one aspect which also gives you consistency here in this case. So beside the fact that you're cutting out emotions in your trading. But let's come back here to the stay connected page. This is what we refer to this. It's the connect tab, let's say. So if you have the Supreme add-on within your MetaTrader, you get access here to this slide where you can check out the data on your trading. So all this data here you found here can be found within the Supreme add-on with the Connect tab within your trading station, or your MetaTrader, in this case, MetaTrader 4 or 5. So you can download it for free, and I highly recommend using this. If you don't use this Supreme add-on, I highly recommend heading over to fxblue.com and connect your account here. And then get all the data around your average. It's not just the average winning trade, losing trade, hit rate, which assets you traded most which didn't work out as expected in the past. Consecutive wins, losing trades, but also average time you held a position, for example, average duration of a trade, for example. So very important trading data. Why, for example, average duration of a trade? This is going a little farther here. Why is this of importance? This is important because you can see, and you will find it out yourself. I know, for example, based on my trading, if the trade works out initially and right away, right from the start, and I don't have to spend any, let's call it mental capital on the trade anymore, because it's now the focus on managing the trade. I know that the trade will work out, because if the feedback is directly positive, you can be sure that the trade will work out. This is something I can also prove by the data itself. So because the average duration of a trade is the smallest or the lowest, in fact, for those occasions where I have a positive expectancy, where the trade works out straight away. This is very important information, in fact, because based on that, you can then start to work out techniques in your trading. For example, like saying, okay, if my average duration of a trade, let's say it's 3 hours, and I see based on my stats that after 30 minutes, let's just bring some numbers up here, just for illustration purposes. After 30 minutes, my trade does not show a profit. Well, it's likely to be stopped out or not move into the take profit target. What does it mean? It means look at your clock while you're trading, see the trade, how long it's open. If it's not showing a positive result after 30 minutes, scale at least out half of the position. Why does this affect your profitability in the trading? Because it brings not down the loss rate of your trading, but it brings down the average losing trade, which directly affects your overall profitability in your trading, for example. That's one very important aspect here, why you have to use technology and why technology is so important, and where technology also comes into play. It's not just you automate your trading, but in addition to that, you use tools which help you to really analyze your trading in depth. And this is where you then connect your trading account with an external platform, which is can be used for free. You don't have to pay for this. So it's FX Blue is for free. The same is also true for the Supreme add-on. Just download it and use it within your trading to get this very, very valuable information for your trading. So now let's come to the automated trade generation and discretionary intervention part. So what we have is that the signals in our that our trades are automatically generated. And then what I usually do, what I prefer to do is, in fact, I have 2 accounts open. So it's one account, it's one live account where I trade my real money, and I have a demo account open. And now I have both, in this case, expert advisors running on both platforms, one on the live and one on the demo account. Hey, by the way, I use a virtual private server. You can also get one when trading with Admirals. Further information can be found on the website. So if you ever wonder what is VPS, it's a virtual private server. It's like it's a remote computer where you can run your EAs or MetaTrader, for example, 24/7, and it's not shut down as is, for example, when using a laptop or so. So now I run it via a VPS, live account, demo account, and I trade the same approach on both of them, at least when it comes to the expert advisor, where these signals are generated in both cases. So automatically a trade generation. And then what I tend to do, or not what I tend to do, what I do is, in fact, I don't intervene in the demo account, but I intervene based on my personal experience. For example, I see an extension on the upside, volume spikes, whatever there might be. And based on that, I intervene discretionary. And at the end of the day, in fact, so I intervene means I have a trade which is automatically generated in both cases. And one trade, I don't intervene at all. This is in the demo account. And I then intervene with, for example, taking out part of a position or the whole position or something like that in the live traded account. And what I then do is I track my, let's call it intervention performance in points or in Rs. And what I simply do is I collect this in the data. What I do is, in fact, I say, okay, today, for example, I intervened here in the live account. The result is, let's say, +1R. And in case of the demo account, for example, the trade just turned around and was stopped out, and I have a -1R. The difference is 2R because I saved 1R in the basic version. And based on my personal intervention, I have +1R at my end, which means it's +1R plus 1R. I save 1R here in the demo account in the basic version. And so I have 2R. I can write it down in my Excel file. The same is true the other way around. Let's assume I take out the trade and the market moves on in the future, near future, and hits the take profit, for example. I take out the trade because I don't think that there will be a follow through for whatever reason. Then I have to write down 1R in my account. Great. 2R in the demo account without intervention. Well, it's -1R at my end. So this is how I write this down. And then what I do is I follow a clear routine here at the end of each month. So what I do then at the end of each month is I compare the results here. And what I simply do is I say, well, if I perform better, I continue what I did based on my experience, intervene. If I don't perform better, but it would have been better to just trade, let's call it the basic approach where the expert advisor here without intervening. Well, then I stop doing what I do respectively. I start to wonder, why didn't I perform better? Where were my mistakes? Where did I make mistakes? And try to improve thus my trading that way. And here, so this is now a real intervention sheet. So based on my personal trading. So just to give you a direct idea of how this looks like in the real world. So intervention sheet means outperformance in R, and then I have, for example, 2.2R better, -0.2, for example, taking out the trades, let's say slightly before we hit the take profit, but the market somehow changes the character, is not moving any further. I then see, so shortly after I took out the trade discretionary, the automated, the fully automated approach here hits the take profit. So it's -0.2R. And I do this over 1 month. And at the end of each month, I just sum up these numbers. And then I just see if it's positive or not. So in this case, I haven't summed it up here. But you can find out my intervention played out nicely. So I smoothened, in fact, the equity curve. And this is a way how you can use technology, in fact, in a very strong way, in fact, and combine this with your overall, not just trading personality, but with your discretionary trading, with your overall experience. So you have a clear path you follow, you have clear based rules, how to enter a trade, but it then comes all down to how do I exit the trade at the end? And then you just see, okay, the basic version without intervention performed X, I performed Y. And if the difference between X and Y is, in this case, positive for me based on my personal intervention, then I obviously use technology to, I use technology, in fact, to increase my overall expectancy here, smoothen the equity curve, and make an already profitable trading approach even more profitable. And that leads us straight direct into the summary. What's R? R, this is Opria just asked, what's R? R is the risk. So let's assume 1R is in this case one risk unit. That's probably a good way to put it. So one risk unit here in this case means like it's the difference between the high and the low of the range, for example, when coming to from the DAX, for example, and it doesn't refer to the overall amount in euro you just risk, or USD or GBP or something like that, but it's R and how you performed in relation here to your overall risk you took. So R multiple is probably also a way to put it. For example, R multiple refers to how much R did you generate based on your overall risk you initially took, in fact. So you might probably say, well, I just made, let's say, 10,000 euros. Well, if you took, let's say, a risk of 100,000 euros to generate 10,000 euros, your R multiple is 0.1. This is very bad. If you risk, let's say, 100 euros and you made 10,000, that means that your overall R multiple is 100 to 1, which is extraordinarily good, in fact. And this is how you can understand this, in fact. I'm sorry, I haven't prepared this. So it's Gert's question is, can you show last month's R performance? So probably they are positive. So in fact, I know that the last month has been positive. And my discretionary intervention had played out nicely, but I haven't prepared it now, so I have to look at it myself. So so now find it here on my laptop. Sorry, I haven't prepared this, but I know that last month was okay, so I'm happy. Let's put it that way. So let's come to the summary. Manual and automated trading have both pros and cons in this context. So as you have seen, so manual trading, there is let's say the how can we say that, the emotional part. Automated trading is very static to some, and then some people might say, well, I'm not taking trades I usually would take discretionary based, but I can't take them because the automation of my strategy does not leave me to take this trade, like the gold trade, for example, as a perfect example. And so what we want to try to achieve is we want to combine the two worlds here and become a so-called bionic trader, so which can in fact make the difference between being profitable and unprofitable. So it could be, so this is something I haven't made a topic now, but it could be that there's a trading approach which is not working well if you just run it automated and there's no intervention taking place. So there's a negative result at the end. But thanks to your intervention, the overall unprofitable, let's call it basic version of this approach, starts to, for a certain period of time, certainly, becomes profitable because you as a trader are so sophisticated and advanced in your trading based on your experience that you can make, and for a certain period of time, unprofitable trading approach here profitable. So this is definitely something which I'd like to point out here. And so where you can also see, I hope that you just saw how it's possible to intervene here and use this and do this on a very so it's not just an intervention you do because you have a feeling, but these feelings sum up. And this is what the last slide here, the intervention sheet, just showed. So you try to filter out feelings here and thus emotions, and here and then the risk of cognitive dissonances, to make it the impact here of cognitive dissonances as small as possible. And so as I pointed out in my trading, for example, there's this automated trade generation technique. So fully automated, you enter the trade. But then what I do is I become discretionary when it comes to exit the trade. And I intervene here based on, for example, my price action knowledge, my overall intuition, fundamental triggers, which might be found, so on and so forth. So probably you can say, oh, I have a long trade in gold, fully automated, generated. But then I see, okay, the take profit is already found slightly above the breakout region. If we have the fundamental trigger now, probably makes sense to take out to take profit. It's not just about exiting the trade before we hit the take profit, but also taking out the take profit and increase the overall expectancy of your approach by letting the winner run even further. So this is also a way how to intervene discretionary here in an automated strategy if you follow such rules then, for example. And as I pointed, hopefully I was able to point out here, a great tool here to use technology in your trading is the so-called Supreme add-on. You can download it for free. I shared the link in the chat box here, and I highly recommend using it. And yeah, use the technological aspect here to increase the overall profitability in your trading. And yeah, in fact, that's it for today, for today's topic. So any further information, please feel free again to share your comments, questions below. If you watch this recording now on YouTube, leave a thumb up here if you like what you just saw. If you have any further questions, also when it comes to the Supreme add-on, downloading the platform and so on and so forth, check out admiralmarkets.com here, select the country of residence, and then contact an appropriate entity here, global@admiralmarkets.com for an email, YouTube channel. I already said it, subscribe, hit or set a reminder so that you don't miss any of the videos which we're uploading there. Follow us on Facebook, for example. Further information, fully regulated broker, very important. So that means that we have to finish here with a risk disclaimer. Please read it carefully. And yeah, I hope that you enjoyed here the webinar. The statistics app. Let me just share it here. So if FX Blue, so that's the first one where you can find it, respectively, it's the so-called Supreme add-on on the Admirals website. Let's call it AM website. So for further information. That's it from my end. all the best. Have a nice weekend. Enjoy yourself. Talk to you again next week, Wednesday, when it comes to DAX trading, and see you there. All the best. Bye-bye.